Good afternoon, everybody.
Good afternoon.
What's up, guys?
All right. I guess we'll go ahead and jump right in. So, all right. So for those of you who don't know, my name's Sean Hadley. Oh, I'm sorry. Go ahead. I don't know if Carrie wanted to do the intro. Oh, well.
Oh no, I was actually going to let you take it away, Sean, but
All right. Totally. It's my first Zoom. Sorry, everybody. All right. So Sean Hadley, CrossCountry Mortgage. Chris and Don are also on this. So as I often say with these, just feel free to jump in. I'll probably kind of leading most, and Don and Chris will jump in along the way. But I encourage you guys, feel free to just unmute and chat, or you can put something in the little chat box, and Chris or Don will give you a heads up what's going on there. So topic for today is going to be mostly geared towards investment loans, specifically the DSCR loan. I love it. I had someone call yesterday and say, I want a DSR loan. I said, great. Do you know what it is? Like, nope. I said, okay, well, I gave them the rundown. I didn't make them wait until 1 o'clock today, but I'll kind of, we'll keep it pretty basic and then kind of get into the details of it. But just as as I normally do, I start with, oops, let me get this going here. Just to give you a little bit feel for what's going on with interest rates. So since the Tuesday meeting, when I said somewhat of a quiet week, there's two inflation reports came out, both coming in a little bit higher than expected, and it actually caused a bit of a boost to rates at first. But we got a chunk of that back. But just so you know, kind of nationally where the 30-year fixed is riding is at that 7.04%. Oops. 7.04% is kind of where the national average is, and that's with 0 points. So just a reminder, Thursday, Friday of each week, you get a notification on the Freddie Mac interest rates posted at 6.79%. When you see that headline posted, that is with points. They don't tell us how much points because that's not part of the survey. It's just, well, what interest rate did everybody get this week? And obviously with points, you're always getting a lower rate. So just want to give you a heads up on that. Doing the little 30-year kind of the short-term look back. I consider 1 year short-term. So just to give you a feel for what interest rates have been doing. There we go. So 30-year fix kind of still hovering right around that 7.25, a little blip there, and nice little tease here in December. And of course, we had that nice little end of the summer. So we've got a little bit of a rally heading into the end of the year. But as far as the outlook, I don't think there's anything really on the horizon that's going to lead to low, quick, and immediate interest rate drops. But you're going to see some volatility. Might tick up a little bit before we see it improve, and higher for longer. As you've heard Mr. DJ been ranting on about those words for the past 6 months or so. So, Chris or Don, anything you guys wanted to add?
I think so.
No. Okay.
No, just try and let your buyers know. Don't try and time the market. If you're looking to buy a house, buy the damn house today. Don't worry about interest rates.
And if you really want to nerd out, we can hit this before we're done just to see what the 10-year is doing and all of that. So, all right. So what we're going to do, so I think we've seen it before, but my face here, not just that, but the CCM. So CCM Greater Cleveland, that's my personal webpage. Don has his, Chris has his, and every loan officer here across country does. So feel free we've revamped this a little bit, made it a little bit more seasonal. So can't wait till spring when that changes. But as you kind of tinker through here, plenty of resources. What I'm going to jump on today's is the DSCR loan. So simple as typing in DSCR, takes you right to our article about it. So I'll leaf through this in a second. But before jumping all in on DSCR loans, I just want to talk about investment financing. I'll kind of fly through this. I've given this presentation many times before, but with every home purchase with a mortgage, there's going to be a classification of one of three items: primary residence, second home or vacation home, and then non-owner occupied, which basically means anything not primary or secondary. And of course, we just think of that as typically rental. So primary residence is defined as a home you intend to occupy within 60 days, presumably, live out of there most of the time, meaning, 51% of the time, and tend to stay there for at least 12 months. So that's kind of a rough definition of a primary residence. A secondary home or vacation home, pretty obvious here, but you live in Cleveland, you're going to have maybe a little cottage up in Vermilion, Sandusky area, or something, a condo down in Florida. That's a second home, vacation home. You are allowed to rent those out, but when you're using it as a second home, if it's classified as a second home, we cannot count rental income to qualify. Non-owner occupied or rental, that's what we're we'll be going into that here a bit today. And if you're buying a house for a child or a mother or father who's on a fixed income, so child usually with a disability, or mother or father on a fixed income, there's some other variants there, but you can buy that property even though it's not your primary residence and still treat it like a primary residence when it comes to down payment and interest rate. So if anybody has a question, just feel free to chime in, but just wanted to cover that real quick.
John, if not mistaken, that last one you could do for as little as 5% down, correct?
Yes. Yep.
Yeah.
So if my parents, I cannot get them out of their bungalow with a whole bunch of stairs, and my dad said knee surgeries and due for more, and they're just stubborn. And they will not move out of that house into a ranch. But if they wanted to, if they couldn't buy that next house, I could potentially purchase that for them with 5% down, with a primary residence interest rate, rather than calling that a rental. So it's an exception that not many people are aware of. And frankly, you'd be surprised how many loan officers are not even aware of how the guideline works as well. But so I'll skip over that one. I'll touch on this one a little bit. So owner occupied, meaning you're going to move into the home. So if you're buying a 4-unit property and going to live in 1 unit, that's considered owner occupied. And you can get away with 5% down conventional, 3.5% down FHA. And in all those programs, you can count the rental income from unit 2, 3, 4 as income. So if I'm buying a house today in a single family home, I qualify for a $150,000 house, and that's it. Okay, cool. That's my limit. If it's a 3-family home and I got $1,000 rent on those other 2 units, that's $2,000 in income coming in, and I can count 75% of that as qualifying income, and that will probably qualify me for $225,000. So rental income is real. This next slide, this is for a rental property. So if you're buying a 1-unit home, 15% down. We're not even getting into DSCR just yet. This is just your standard conventional Fannie Mae or Freddie Mac. 15% down is required, but you get hammered on the interest rates, on the PMI, and on the closing costs by way of points. So if you can get to 20% down, doesn't matter if it's CrossCountry Mortgage or anybody else you're talking to, 20% down is going to give you a much better deal. And if you get to 25% down, it's going to be even better in terms of the interest rate and points and everything else. 2 to 4 family, Fannie Mae, Freddie Mac, conventional, 25% down right from the rip. So that's automatic. And all of those funds have to be your own fund. So if you're buying a rental property and maybe, my brother-in-law's, maybe he's got shaky credit or maybe self-employed and we don't want to put him on the loan to get things messy. He wants to give me the money for the down payment. Can't do it on a rental purchase. If I've got enough of my own money, then I can show that and use that. And yeah, you get, create a partnership post-closing, something like that, but we can't use those funds as we go through the loan process. Does anybody have any questions on that? Nope. This is kind of just in general. This will sort of dovetail over to the other, to the DSCR as well, but rates and points often come into play a bit more with investment properties. If you guys want to chat more on that later, we can. Additional reserves are required. So what reserves are additional funds in the bank post-closing. So if I'm buying a $200,000 house, I'm a first-time home buyer, and I've got 3% down. It's coming from family as a gift, and maybe the seller's paying closing costs. I can literally buy that house without having $1 left over beyond closing. Well, if you're buying a rental property, in addition to needing more money down, we're going to say, not so fast. We want to make sure that you, Mr. Investor or Mrs. Investor, have extra funds in the bank, because you may take ownership of this house and may not be able to rent it out for 6 months, or maybe need renovation. So they want to show that you've got X amount of reserves, and a rule of thumb is generally 6 months. There's some other formulas to that, but in short, figure 6 months reserve. So if my mortgage payment is $2,000, I need to have $12,000 in reserves, checking, savings, investment loans, IRA. If you're using a 401k, that's okay as long as you have access to it. Most aren't aware, but if I've got $50,000 for 401k and I say, hey, I want to pull $10,000 out, the 401k is going to say, what's it for? And using it for investment property might not be allowable. Primary residence surely is. Medical emergency surely is. To avoid foreclosure of a primary residence probably is, but investment property often not. Chris or Don, anything you wanted to add on that?
Not
No?
much to add. It's pretty straightforward.
Yeah.
Seller concession. So, on a conventional loan, primary residence, you're allowed to get 3, 6, or even 9% seller concessions. By the way, if a lender says go get 9% in seller concessions, get a second opinion. But on an investment property, you can get 2%. So in a $200,000 house, maybe there's no cost credit negotiated up front, but the home inspection, maybe there's a few shaky things in there. You can't get a $5,000 credit on a $200,000 house. You're capped at 2%. So that's a hard and fast rule. Fannie Mae, Freddie Mac, everywhere. No gifts. I mentioned that. Property management company. I've been doing this for 25 years, and I've done more investment loans the past 5 years than I have the 20 before that. It's just absolute bonkers. It's the new way of the world. It's a great way to build equity long term. And I don't say unfortunately, but a lot of these are out of towners. I much more prefer working with an in-town investor because I hate to see rental dollars going out of state and out of the area. I so much more appreciate those funds and the circle of the economy kind of staying local. And then that, obviously there's a whole nother
And
topic.
you also, Sean, have that kind of an absentee landlord.
Yeah.
If they don't have a management company. So you always try and give them a management company to use to handle these properties if somebody's in California or New York, because it really is difficult to do without a management company to manage property here being out of state.
Agree. And if there is a sudden turn in the market and, investors go belly up, that's going to be tough with an out of town investor, especially, right? Cool. And what this is, some of you may know this is becoming more and more known, but did you know you could put a rental property in an IRA, and that be your investment? So instead of having $100,000 in, mutual funds in an IRA, you could do a property. There's a whole different process for that. CrossCountry Mortgage may or may not be able to do the loan for that, but there's some other rules out there, guides out there for something like that. So just kind of an FYI.
Talk to Wendy on that one.
There you go.
Yeah.
All right. 1031 exchange, HELOCs. I know I want to say it's 2 weeks from today. I know there's that ongoing investor sort of series out of the Lakewood office, I think. I know, DJ, you're active in that. So any of these things, if you're looking to expand on more, obviously feel free to reach out to the three of us, if it's finance related, but there's plenty of powerful tools and people within this office. So, okay. So non-QM. So what's QM? It stands for qualified mortgage. It's basically kind of a government label I'll give you the very, more kind of generic explanation, but Fannie Mae, Freddie Mac, FHA loans are QM loans. So basically the government's all into those. If it doesn't fit within the government's definition of a qualified mortgage, it's a non-QM loan. The points aren't capped by as much. You can do loans under an LLC. You can do a higher debt ratio over 43 or an automated underwriting approval. So there's a bit more to it. So there's a DSCR loan. I'm going to get into that in a second. But just to kind of preview some of the other ones, 1099, taking title on LLC. In fact, let me just jump over to the DSCR stuff. Does anybody want to take a stab at what DSCR stands? Oh, I got it on the screen there. Hold on.
There it is.
So if it does not stand for do something, you crazy realtor. How about that? Elliot, I saw you raise your hand. You got a stab at it? Oh, of course he's on mute. All right. Well, all right. Debt service coverage ratio. Oh, I'm sorry, Allison. I missed it.
It doesn't matter. I Googled it. I cheated.
I love it. She cheats and is honest about it at the same time. So debt service coverage ratio. And if I had a nickel for every person who called me wanting a DSCR loan, not only didn't know what it stand for, but had no idea what it was, it's kind of the cool thing to say. There's enough TikTok videos out there about it. Where it's kind of becoming a fad, and hey, it's a loan product. And we've offered this program not for like a couple of months, but for literally a couple of years. And we are doing a ton of them. So to do a little shameless here, CrossCountry Mortgage last year did $43 billion in loans. We are, depending on which list you look at, the number 1 to the number 3 retail lender in the nation. And we just got, but we're based in Cleveland, Ohio. How's that possible? We've got 300 or 400 branches nationwide, all 50 states and Puerto Rico. And this has been a huge one for us. And Ohio, Northeastern Ohio especially, is desirable for the DSCR loans because of the way the property's cash flow here. So we'll get into that in a few minutes. And I myself, Chris, Don, I'm sure we could throw out some examples just where this program, investor in general, has been great. So just to get into this, I'm not going to read this. I mean, feel free to go to my site and copy and paste or plug this or post it, whatever. But I'm going to give you the very short version. But and I'm going to, of course, cite it with examples and such. But what the debt service coverage ratio is what we're looking at is the cash flow versus the monthly debt and obligation. So let's just take a nice round $200,000 house, or let's keep it a $200,000 house, and someone's putting 25% down. So that's a 200 house, $50,000 down, and they've got a 150 mortgage. And of course, we're looking at what the mortgage, taxes, insurance, if there's an HOA fee, looking at what that is. Now, let's just say that's $1,200. So we say, okay, well, the monthly obligation on this, taxes, insurance, everything included, is $1,200. They're going to turn around and rent out this 2-unit property for $1,000 aside. That's a $2,000 rental income. I'm not real good at math. Just kidding. I am. 60. That's a 1.66 debt service coverage ratio. DJ, Chris, do I get that right?
2,000 versus 1,250.
Yeah, 1,200.
Yeah.
Close enough. Anyway, we like to see that. We like to see a 1.25. So if $1,200 is the monthly debt, we'd like to see at least $1,500 in cash flow. But you know what? We'll go down to 1-to-1, and even in some cases, we'll go down to a 0.75. That means in some cases, on this $200,000 house, $1,200 mortgage, taxes, and insurance, if the rent is only $900, there's a pretty good shot we'll do it if the buyer is willing to maybe put a little bit more down and has good, strong credit. So it's a common sense loan. And what we're looking at is the buyer's credit, their down payment. We like to see that they have a landlord history, but that's not always required. But we're just taking common sense. We're not going to ask the buyer, hey, where do you work? Are you full-time? Are you self-employed? Are you a realtor? What's your Schedule C look like last year? We're not going to look at income. On that part of the application, it's blank. So these loan applications, they go a little quicker getting through the process, and the documentation is a bit less. You do have to own your own home and or have a landlord experience. So you don't have to be a landlord. In the past you did, but it does help. But as long as you own your primary residence, you can be eligible for this. And it's kind of almost set up or built like a small business loan. If you are buying a commercial property, let's say, DJ?
John, that last statement you made about having to own a house, the primary residence in order to do this, do you know of any exceptions that we've made for somebody that does not own a home that has tried to do a DSCR loan?
Not personally, but I bet you we have. If the buyer's got strong enough credit, especially
assets,
assets and good strong credit, maybe they're willing to put 30% down instead of 20 or 25%.
Because this is a product that, according to Pete Finkelstein, a guy that runs our non-QM department, it's a product that these non-QM products, we have a lot of exceptions available for the right client, which is usually assets and credit, right?
Yeah, absolutely. I mean, I kind of, from probably 2012 to 2000, everyone's like, oh, do you have portfolio loans? Do you have portfolio loans? Yeah, we do. Do you know what a portfolio is? No. But I was told to ask if you guys have them. And because the portfolio was always, okay, can't go conventional, can't go Fannie Mae, can't go Freddie Mac. We'll stuff it into the portfolio, kind of a one-off. That's the non-QM world. And these are underwritten in-house. So we're working with CrossCountry Mortgage underwriters, CrossCountry Mortgage closers. This isn't something where we're like partnering with, one of the countless other lenders out there and kind of bound by their terms, their timeline, their process, and their rules. So yes, this is except like if we have a cookie cutter, crystal clean, property and buyer, but they don't own a home, we're going to run that through our exceptions. And close to half of our loans in these portfolio and this non-QM come with exceptions. So,
And as you know, Sean and Chris, what drives exceptions are assets.
Yeah.
If you have assets, you will usually get the exception, as Brent kind of stated there, seeing a DSCR loan with heavy assets. Heavy assets will get you an exception 99% of the time.
Absolutely. So with this DSR, if you think if Allison said, "Hey, I'm going to go buy a office building. It's just a dinky little office. Maybe it has a deli in the base, or let's not mix with deli or businesses. But let's say just a 4 or 6 unit office building. Well, they're going to look at Allison's credit. They're going to look at her income, but most of the weight is going to be, okay, well, what is that property costing on monthly, and they're going to look at a little bit more of their expenses and upkeep and management, but they're looking at what is the cash flow, what is the revenue generated from this business on this commercial loan. That's kind of what this is. They're looking more at the income that's being generated, applying some level of common sense. Common sense is not, those two words don't work in the mortgage world typically, but it's being applied here. So it's kind of fun. And even when these programs came out, it was always just like a little dodgy. And even when they first rolled out, while they were, light on income documentation or no income documentation, they were heavy on a lot of others. Like, okay, you're gonna have to get 3 months of bank statements instead of 2. All right, you have to get rental agreements on this property. It's streamlined a bit and very, very kind of easy to roll with. So you can put a DSCR loan in and out. Fannie Mae and Freddie Mac will not let you purchase a home and put in the name of an LLC in the state of Ohio. This program, we will. I did a DSCR loan. It was a messy one because we had 3 people buying the house, 2 people on the mortgage, and the third person who wasn't on the mortgage was an LLC, and that LLC was split between 3 people. So we had essentially 5 people buying this house together, and it was a night. The only headache this house appraised for, it was a property in Hocking Hills. It was being used as an Airbnb. Great investment, great property. The only chaos was just showing who owned this this entity in an LLC. Airbnb. So let me jump back to that. Airbnb, we can use that as opposed to what the monthly rent would be on a long-term lease or a 12-month lease. So if somebody's buying a property in Vermilion, as long as Vermilion doesn't have restrictions against Airbnb or whatever we call it, short-term rentals, we can count that income. So how do we measure that? So if the seller has rented it out as a B&B, we can use that as a resource to kind of quantify what the rent may be. Or there's something called it's called AirDNA, if I'm not mistaken.
Yeah.
Is it okay? It's kind of like a third party sort of vendor that'll give you an assignment of that B&B. Somehow it got the algorithms to measure that. So these are other fallback sources. We still have to do an appraisal in the home. We're still going to ask the appraiser about what the month-to-month rent might be, but it's a great option. I know, Don and Chris, anything to jump on there? Nope.
So
1 to 4 units. We keep talking about rolling their 9QM into 5-6 units. We aren't yet. We are doing some mixed use, maybe not necessarily as a DSCR, but the mixed use. So if Allison does want to buy one with a deli on the first floor and an apartment on the second floor, we do have some programs for that. They're relatively new. They're a little clunky and going to be kind of a white knuckler to get through, but we are rolling programs like that out, routinely. So just zipping through here.
The other side of the coin too, Sean, with the DSCR loans, you're not limited to 10 loans.
Yep.
You know, you could do 15, 20 loans on these things as a non-QM product. Fannie limits you to 10, Fannie Freddie.
Yep. Fannie Freddie, once you get to 10, you run out of mortgages to take. That 11th one could be a DSCR, or even doesn't even have to be a DSCR. If they got fully stated income, documented income, I should say, they could just do a regular non-QM. If there's a downside to DSCR, you are going to pay a little bit higher interest rate than, a fully documented. So if let's say somebody's putting 25% down on a 200,000 single family investment, 30-year fix for, conventional might be kind of in the mid sevens, might even sneak in the low sevens, especially if you're willing to pay points. You might even be in the sixes. With the DSCR, you're generally running kind of half to 3/4 above. And you know what's allowed on these mortgages? Not required, but permitted, prepayment penalty. So most people are not up for a prepayment penalty, but if buyer wants to say, hey, you know what? One of my customers last year, it's a long-term. They bought when rates were kind of on their way up, and they're very happy with the rate they got. They took a 5-year prepayment penalty. Now the penalty is just 1% of the balance. So if they do pay the loan off or refinance, they have to pay a whopping 1% of whatever the balance was. But that's it. And they were able to lower their interest rate by, I think, close to 0.5%. So it's a business decision. We don't require a prepayment penalty, but to say, hey, by the way, if you want a prepayment penalty, here's how it works, and this is what it would cost you. And the way this one looked at it is, okay, so if I run it for 5 years, I saved whatever it was, 0.5% on the interest rate for 5 years. And if I end up, not keeping it for 5 years or refinancing or paying it off, then you got to pay that. Yep, that's exactly how it works. So he analyzed it and kind of considered it low risk for him and just ran with it. So anyway, great program. Any questions on the DSCR loan? No? Okay. Like I said, it's been very.
Question.
Oh. Somebody have a question?
Yeah, this is Charles. I'm sorry.
That's all right.
I sent you a message. I just want to clarify. So DSCR loans are limited to only 4 units?
With us and with most lenders, generally right now, it's going to be 4 units or less, all residential.
Okay, so if you wanted to do a bigger, a multi-family, that'd be more of a commercial loan?
Yeah, so like anything that's of a 5-suiter or like a 20-unit apartment building, that's going to fall under the commercial world. We don't have programs for that yet. I mean, I think Chris, myself, Don, each of us have kind of a go-to person external from CrossCountry for something like that. But yeah, nothing in-house or anything that would be related specifically to DSCR.
Okay, thank you.
Yep. Yeah, and that's I think a lot of you on this call know the three of us well enough to say, hey, yeah, we're humble enough to say, I mean, if we have some weak points as a lender, lot loans, not necessarily great there. Home equity line of credits, we have a resource, but I would say it's not our strongest suit. And then commercial. So those three oftentimes will let you know what we have, and in some cases give an alternate option.
John, are we allowing renovations on these DSCR loans yet? There's a question.
I don't believe so.
I don't think we are.
Not yet. We are doing renovation for investment property. It's going to be a pretty hefty, investment down payment requirement. You've got to commit to keeping it for 12 months. But we are not coupling that with a DSCR. I will say the interest rate, the DSCR and all the non-QM, we do cater. The interest rates are going to be more favorable at the higher loan amount. So, buying a $300,000 house versus a $125,000 house, you'll see a difference in interest rate just at that higher loan amount. So for what that's worth.
Because I think the minimum loan amount on these is 125, if I'm not mistaken. We can get an exception to go lower. I think we were able to go down to an $85,000 loan amount, but technically 125 before we start asking for exceptions and or which is going to create pricing hits for the exceptions. Right?
Yep, exactly right. And I think with most savvy investors, if somebody's talking about a DSCR loan, usually it's because they can't qualify conventional because of some income reason. Maybe they're just overly extended, or maybe they just quit their job to become a full-time investor. There's a lot of reasons why we might be drawn to this, but don't get too caught up into the interest rate. I mean, easy for me to say as a loan officer, we stare at interest rates all day long and, live and breathe by the ups and downs of that market. But realistically, just like when a first-time home buyer is buying a house, they shouldn't be running out to buy or avoiding buying because of where interest rates are by in and of itself. Most investors are going to be savvy enough to say, okay, well, yeah, if this is cash flowing, that's going to make sense. Not to say, again, not to say belittle the importance of an interest rate, but just, mentioning that. With the getting back to, why Cleveland is such a hotbed, or Northeastern Ohio, and even argue Ohio, the Midwest maybe even, is the cash flowing property. So there's an investor I met. I had done over a 18-month period. I had done 9 loans for him, and he owned one single house in Oregon, however you want to go on that. And he sold that house for 250, walked away with $250,000. And he was moving his portfolio of investment property of one and converting that to, Northeastern Ohio. Short version of this story is, I asked, why did you sell that? He said, well, number one, he wasn't cash flowing. That property, the only way he was making money is to be in it for the long haul and selling and getting the equity, which he did, but just shorter than his original plan was. The second part was he had a tenant who wasn't paying, and the eviction process takes up to a year in, the county or city that he was in. So he was just totally kind of handcuffed. So he said, all right, I'm going to buy in Cleveland. And he said, I'm going to hopefully keep these for 5 or 10 years, but yeah, I'd like to pick up a little equity in that, but I'm not in it for that. I know in the long haul, the margins, the increased appreciation is going to be modest in Northeastern Ohio. But on all 9 of the properties I did, he was cash flowing, not barely, but by several $100s. Now, keep in mind, this is in 2019. So what happened to those 9 properties over the years to follow? Well, the unpredictable COVID, the shortage and housing, and he's refinanced 3 or 4 of those and pulled cash out for other investment property. So again, he kind of got the best of both worlds with, what ended up being from modest cash flow to severe cash flow, and now a plethora of equity, and it's working out great for him. So of course, he tells all his buddies, which is in essence good for us in the business. At the same time, you got more people from the West Coast, buying properties and buying in here because, with all of that money in Oregon and California was where he lived and moved and owned. In short, he would have been able to put maybe one investment property out there, probably wouldn't have cash flowed and just would have made money on it, but it just would have taken a long, long time. He's hooked up with an agent who obviously loves him. He's hooked up with a property management company, and thankfully he has a good loan officer as well. So there you go. He doesn't need DSCR loans, but if he quits his job tomorrow, he can still keep doing this with a DSCR loan.
I have a similar story, Sean. I had a couple that worked for Boeing out of the state of Washington. I think I did 10 loans for them in Akron. They're up to 18 houses now. Because of the cash flow and what they're able to buy these properties at. They quit their jobs at Boeing, believe it or not. He does some occasional consulting for them, but they now have a house here in Ohio, South Carolina that they stay at, and another one in Mexico on top of their 18 properties by buying rental property. So real estate's where it's at.
And he's probably that one of those Robert Key. I guarantee he's got Rich Dad Poor Dad somewhere on his shelf, and getting out of the rat race and all that. I sound jaded here, but I so much love hearing this from local Cleveland people as well. So anyway, yeah, you don't need to preach us to the benefit of home ownership and investment. We're talking to a bunch of realtors, of course. What I was just going to do before jumping off this page, just kind of zip through some of the other non-QM programs.
Hey, Sean, you got a DSCR question here from Charles as well. What is CCM's timeline requirement to refinance a DSCR loan?
I'd have to double check that. I think if you're looking to do cash out, you're going to have to wait most likely 12 months. There may be an exception down to 6. So if you're looking to do cash out on a property that's owned, but if you're like thinking, okay, I'll get in with a DSCR loan and then I'll refinance to a standard conventional, that might only be 6 months. It may even be less than that. So I don't know, Chris or Don, do you have an answer for that one?
I thought it was 6 months from the note date.
Okay.
That's what I
Sounds
thought I
right.
read. Yeah.
Sounds right. Yeah, Charles, feel free to chime in if we didn't answer that. So any other questions on the DSCR loans? There's no realtor faces. How great was that? Do something crazy, realtors. Was that good? I know Chris and
I liked it.
all right, good.
There's a nice Hadleyism.
So just some other programs. This is not DSCR, but they kind of fall under the same umbrella for that non-QM as a bank statement loan. So let's say I'm talking to a guy who, let's say he owns a deli, and he's Allison's customer since I don't know, I'm on this deli kick with Allison here. But and he sells a lot of sandwiches, but he pays a lot for meat slicer, delivery, and everything else. And when he files his taxes at the end of the year, he only shows, well, a very modest income. And with Fannie Mae, Freddie Mac, FHA, we're going to look at tax returns to show what their business income is. Well, a bank statement loan says, don't show us your don't show us your tax returns, just show us your bank statements. We just want to see all the deposits. We're going to take the deposits over a 12 or 24-month time frame and average those deposits. That's what we're going to consider your monthly income. That's what a bank statement loan is. So we're verifying income, but on a much different way than tax returns. So that's pretty much for self-employed only. Excuse me, business owners. ITIN. This would be. I'm thinking of the foreign national. ITIN. DJ.
That's a foreign national loan.
Okay, foreign national. So somebody who is, legally allowed to be in the U.S., whether visa or whatever, but they generally reside, their primary residence is outside the U.S., we can do a loan for them. It's treated like a DSCR in most cases. There are side one-offs on that, but generally that's the way we look at it. 1099 mortgage. Anybody on this call have 1099 income? All right, there we go. So let's say that somebody has 1099 income, just nice round number of $60,000 a year. And they meet with their accountant in a few weeks and are very, very, very detailed and have a lot of, mileage to write off and signs and advertising. And by the time they're done, they show the IRS that they had a great year. They made $14,000. Well, when they apply for a conventional Fannie Mae, Freddie Mac, FHA, VA, we're looking and say, $14,000, that's a little lean. That's going to be tough to qualify. I'll tell you what, we've got a 1099 mortgage where don't even show us your tax returns. We're going to look at that 60,000. We're going to knock off 10% just to have a little variable. We're going to consider your income $54,000. That's now what you qualify at. So that's our 1099 mortgage. Got a pretty strong credit, nice assets would be great. Interest rates certainly going to be a bit higher than your Fannie Mae, Freddie Mac conventional, but it's a great one. And sometimes we have this. I think we still have to show that you have a 2-year history of it. We're going to look at the 1099s for a couple of years, but it is a great, easy.
That is a tremendous product.
Yeah. And 1099 doesn't even fill up a whole page, so it's a documented income, but a much more leaner version. So a cool one. Asset qualifier. I will tell you about this one. Had a customer I spoke with during the week about, hey, do you want to get pre-approved? This was last summer. Do you want to get pre-approved? No. I just want to find out how it works. Saturday at 7 o'clock. I'm on vacation with my wife and kids and having a lovely time, and they want to put an offer in. 7 o'clock, all offers due at 9 p.m. Finally, I driving back to my house or little condo that we rented. Sorry, just making the story much longer than it needs to be. Anyway, long story short, we pull them. They got great credit. We have a couple, they're engaged to get married, both in their 60s. He just retired and hasn't signed up for Social Security and is moving all of his 401k to an IRA and has income of 0. She just got out of a divorce, no support being paid, and just got half of her, the assets were split, and they both have a big chunk of money. They have not one penny of verifiable income other than the interest on their money that they made this past month. So they're looking for a $400,000 house with 20% down. I said, you know what? We've got this other loan. It's kind of a Hail Mary for you, but It's just where we look at your assets. We leave the income blank. We don't ask for your tax returns. And they had about $600,000 between the IRAs moving around and the funds between the two of them. That was 125% of the mortgage amount or more. We gave them that loan. So it's an asset qualifier. We leave income blank. We look and see how much money they have. Now we have to look at their assets over a 6-month period because we want to make sure the money just didn't show up out of nowhere or come as a gift from a family member 3 months ago. So we do look a little bit into the history of the assets, but it's a slam dunk. So can you buy a house with plenty of assets and no income? Yes, you can.
You're saying, Sean, if they were buying a $400,000 home, no income, had 600,000 in assets, and we were able to do the loan.
Yes.
Yeah.
Yeah. Beautiful. And it was
you have to be retirement age 59 and a half or more.
You do not. So if you're under 59 and a half, we're going to look at the cash assets or the liquid. The assets that can be liquidated from. So if you've got a 401k with 200 in it, but you only have access to 50,000 because you're under 59 and a half, 50,000 is all we can count. So we're going to look at what you have access to. But you do not have to be 59 and a half for that loan.
John, what's the minimum credit score and the maximum debt to income ratios on these? That was a question in the chat.
All right. So here's this is a guide, but if you have a 620 score, you may indeed be eligible for the DSCR loan, but you're probably going to require 30% down. If you've got a 760,
and you're going to get hit with cost pricing,
and you're going to pay a lot more in rate and cost. It's just it's risk based. Down payment 20% is going to be eligible, but you're going to have stronger credit. Minimum loan amount here 100,000. That might be 125 now, but essentially if you've got an investment property that's going to be under 160, under 150, we want to take a closer look at it just to make sure that we're not going to hit any floor that we're above any floor, whatever it might be.
And DTI maxes out around 50, right? 45, 50.
Well, there is no DTI on a DSCR.
Well, on the asset qualifier.
Oh, okay.
Well, asset qualifier, there's no income. So the only one of these that the debt to income ratio would factor in is going to be the bank statement loan and the 1099.
Okay.
So foreign national is going to be treated like DSCR, no income, and the what was I just talking about? Oh, and the asset qualifier, no income to be listed. So pros and cons of DSCR, I think we touched on all of these. Oh yeah, DSCR cannot move into the property. So I had a lot of people go, well, okay, well, I just lost my job, so I want to buy this house as a DSCR. Can't. You can do it, you can't live in it. Now, there's saying you can't live in it, and then attesting to the documents at closing that are notarized that say you will not move into this home, period. If you do, what are the ramifications? Well, somebody has to look back and say, did you lie on the application? Did you commit loan fraud? Maybe there was a life change, maybe there's a legitimate reason, but nobody wants to have that investigation open. And when that investigation's opened, everyone is on that investigation. The loan officer, the appraiser, the lender, the buyer, the realtors, in some cases the seller. So we gotta always take those serious. So that's more or less, I think, what I wanted to cover today.
Hey, Sean, did these loans take any longer to close? No.
Nope.
I closed a DSCR loan in January, 16 days.
That's wild. I mean,
yeah, I'd say they're almost faster.
Yeah.
And in the beginning, when these came out a few years back, the underwriting was slow because I think they were still trying to find out what the norm was, kind of establishing a process here. And we've done so many of these. And again, we don't, obviously the three of us are doing business mostly here in Northeastern Ohio. Granted, we do loans all over the country and Puerto Rico, but the West Coast, Florida, we're doing these like crazy as a company. So we've got a real good streamlined process for getting this through. So it's great. And years ago, when these programs first came out, we were not doing them in-house. We were doing them outside on a broker relationship, which we still can do. But that process, like I said, is clunky. The rates seem to change without notice. And, we're working with someone else's underwriting department. So, we know the first names, we know the people on the other end of working on these files, which is pretty cool. Any other topics or any, this is a fireside chat where it happens to be me just screaming and every now and then Don and Chris get a word in edgewise. But is there anything else you guys want to cover while we have today? No? All right, cool. Well, as I hope everyone knows, feel free to call, email, text us. And as I always kind of say during the wrap up, don't feel like you got to be an expert with everything or anything necessarily that we spoke here. Just know what's available. Hopefully, you've got enough to kind of regurgitate and share with somebody who might be interested in. But just feel free to pass our information along. If anybody's we have done first-time homebuyer classes, investor classes. Frankly, that little PowerPoint that I kind of zipped through in the beginning, that gives most any buyer, especially a first-time investor, all the detail they need. And if you just have a customer who just says, hey, this person's thinking about getting into investing, they're a little intimidated, or maybe they're not, they just need to hear what happens in the mortgage process, we'll explain it to them that way. Fannie Mae, Freddie Mac conventional is going to offer the best terms. Fallback is DSCR if there's a shortfall there, and then we just look at everything else in between. So just feel free to reach out to us anytime you need. Chris, Don, any parting shots?
No, if anybody's going to family reunion, see you next week. I hope to see you Tuesday night at the happy hour or event we're going to be hosting at the restaurant.
Yeah, Don's buying drinks and food and a whole bunch of other stuff, and a ride, I think, too.
And so a ride.
We got you covered.
Ride there, ride back. We feed you, we drink you, and get you out.
All right. Well, hey, for those of you heading out, enjoy Vegas, and thanks everyone for coming on here today. Really, really appreciate it.